The lines you see here, this is kind of like what I was getting at yesterday, where you want to start populating your chart with, you don't have to go back in time. You can just start doing it walking forward, which is essentially what I have here. I just picked the Sunday new week opening gap, and that's as you see up here. And I want to take you to the chart where it actually is formed so that we can see it. And then this is how I recommend that Caleb labels his. Okay, so while it's not important to have these on the chart you're watching, all day long or minute by minute, or if you're looking at a chart like a less than 1 minute chart, 15-second, 30-second chart, it's not important to view it from this perspective, because once you see where you're at, like for instance, we're here right now. This is mark to market there. That's real time. And we are just below Wednesday's new day opening gaps low. And we are above today's new day opening gap high. So we're in between, okay? Which is classic. It's typical because we're waiting for a medium high impact type of event at 8:30. Now, when we do not have high impact or medium impact news in the morning session, I still am watching these levels because at 8:30, the element of time is still there. So the algorithm is going to just walk forward. It's not aware. Okay, this is kind of like me saying probably too much more than I should, but this is why I say I don't care about the numbers that these reports present to the public, because at 8:30 the algorithm is going to start spooling anyway. Okay, on high impact news drivers or medium impact news drivers, they can push it a little bit further. I'm not saying that it's absolutely 100% manual intervention, but they will loosen it up a little bit so it starts to reach for a little bit farther outside the normal band of volatility, where it can go up a little bit further than if it was without a news driver that would be either medium or high impact. And what am I referring to if this is the first time you're watching? If you go to forexfactory.com, I don't have an affiliate with them either. I don't have anything with them, but they have a calendar that I've always used. When I was on Baby Pips, I used that calendar, and when I was teaching Forex and price action through Forex, that's the one I would use. You can still use it, but I prefer Econoday, and that was the one I was using a long time ago. And it's a little bit harder on the eyes than the real nice presentation that Forex Factory does. It's a real cleaner, easier, and Econoday gives you a whole lot more information that I don't personally think you need everything that it shows, but if you want to be a completeness freak, like you just have to know everything, Econoday is the better economic calendar. Okay, and it's free. You can go to their website, and there it is. If there is an absence of medium or high impact news in the morning session at 8:30, I still am watching 8:30 because the market will in fact still spool. Because it does that, I'm already looking at 8:30 anyway because it's a key time. It just makes it better, more probable that we'll have a lot more volatility, and the price runs will be a little bit more energetic when we have a medium impact or a high impact news driver that's due out at 8:30. Now, at 8:30, when we have something like we have today, this is classic where we'll be sandwiched between just waiting for that news to hit. Everybody that wants to play breakouts, okay, they're going to want to be a buyer, maybe above this high or that high. Short sellers are going to want to sell short here on a break below those levels or above those levels, respectively, because they don't know what they're doing. I'm suggesting to you that we have to sit and wait, because it's not in an area where any one particular direction is more likely than the other. Let's say it that way. So let's go through a process of, this is what we're practicing. We're looking at a time when the market should start running in about 7 minutes or so. And then we want to watch and see how price reacts and delivers to. I'm going to scroll back real quick and show you where the new week opening gap high, the consequent encroachment, which is the midpoint between the high and the low, and it's labeled, as you can see here, okay? And then here is Tuesday's new day opening gap, which you get that on Monday at 6 p.m. Eastern Standard Time. And then here is Wednesday's new day opening gap high, midpoint, new day opening gap low for Wednesday, which you get on Tuesday at 6 p.m. Remember, the 6 p.m. opening price gives you one or the other, the new day opening gap high or low. And wherever that 6 p.m. open is, if it's above where it stopped trading at 5 p.m. that same trading day, then that's going to mean we have an up gap or opening gap higher. And the higher reading would be your high or your new day opening gap high. And then where we closed at 5 p.m. for that 1 hour break, if the close is lower, then that would be your new day opening gap low. And then you put a fib and measure the difference between both. And that 50% level is your consequent encroachment. So that's your midpoint. You don't need to put the quadrants on it, okay, like I was teaching yesterday. After a while, you'll just trust the fact that you can eyeball it. You don't have to be so precise about those levels. I like to do the quadrant levels when there's a larger range, okay? And this particular range, this is one where I would have the quadrants on. If it's a smaller range, like say the new day opening gap is like 10 handles or 15 handles, something less than 20 handles, I'm going to eyeball it. I'm not going to worry about the actual specific levels because we're talking about very little in terms of separation from where a trade might be entered and where a stop would be. It's not going to be an impact to me for making or breaking a trade. But this is a significant range here from 18,099 to 18,033. So we have 66 handles or so in here. So that's a pretty significant price range. So you would want to look at the quadrants in that, and you simply would just, when you put the fib between the high and the low, that makes up that new day opening gap. And if you don't know what I'm talking about and you didn't watch yesterday's presentation, go back and watch it. Okay, don't skip ahead, because you're going to watch the video and be frustrated. You have no idea what I'm talking about, or assume that I don't care that you are trying to learn it properly, because I've already outlined it yesterday. But when you put the fib on the low and the high of that gap on your Fibonacci, you're just going to toggle 0.75 or add it into your settings, 0.75 and 0.25. So it gives you your quadrant levels in addition to the 0.50 level, which is the consequent encroachment. So you can see where everything is anchored. Here, here, here. But I want to scrub back and show you where we opened. So here's where Friday's trading closed. And then here's where we opened on Sunday. See that? And then measuring the distance between the close on Friday and the open on Sunday at 6 p.m., your 50% level. Now on new week opening gaps, same thing. If it's a significant new week opening gap, I want to put the quadrant levels on. Okay, so I'll do that here so that way you can see it. This level was dropped in, so it's not a fib. You can see that. So that's how I keep the chart clean, and that's what I'm suggesting to you, Caleb. All I'm doing is when I put the fib on, I'm measuring the open to the close, and you can see it's the same price level. So 451.75. Let's take that Fibonacci off. 451.75. And all I did was drop the horizontal line, which is this one here, and put it on that price. And if you have to calibrate it, you just drop it in close proximity to it, and then coordinates, you just put the price in, 18,451.75. And then if you have to move it around, you just do these types of things here. So that way it's sitting either below the high or just above the low. So that way it's closely correlated. So that way you know what you're monitoring. But to get the quadrants, when it's an opening gap like that, these are the settings again, real quick for clarity's sake. You're going to have these in your Fibonacci settings. So if you toggle them 0.75, 0.25, that'll give you your quadrant level. So I'm adding them now so that you can see. You think that's random? You think that's random right there? Some of you have already mentioned to me either in an email or a direct message to me on my cell phone, and I've asked you politely not to do that. My phone's been buzzing since 11 o'clock last night with everybody wishing me happy birthday. While I appreciate that, you can just as well do it in the comment section on a most recent post on the community tab on my YouTube channel, because that's like the replacement for Twitter. So while you don't see other people commenting, I see every comment that's made to me. Anything rude, I broom you. I don't never need to see anything from you ever again, because I frankly don't care about your opinion. You're either here to learn or you're not. If you're not here to learn, piss off. So we spike through it. The wicks do the damage, and then we come back down. Look how it hits the bottom of the new week opening gap there, and then accelerates lower. What is it reaching for? Well, you have Tuesday's new day opening gap there. It trades into that. Look at the consequent encroachment of that level. Bang. And then we come back up, hit the low of it, inside of a fair value gap, trades lower. Here is the Wednesday new day opening gap. Look at the bodies respecting that. You see that? The wicks are going to do the damage. Okay. And then we have, look at this, completely random, comes back up, consequent encroachment, trades lower, one more time, drops back down. And now what have we done? 8:30, we traded up to Wednesday's new day opening gap low, consequent encroachment, high. See if we can hit it. Just a little bit more of a spike. There you go. So what I was talking about yesterday, when we're looking at price, how do you learn to trust where the market's going to gravitate to? Okay, like which side the market's going to reach for. Do you remember what I told you that you're going to focus on? If you've taken notes, you should already know this, because it's basically staring it in front of you right now. If the market's here, okay, and we have only today's new day opening gap, which is here, that's below opening right before 8:30, before the run that's on that news driver, where are you seeing clustering of new day opening gaps and a new week opening gap? Where do you see it? Is it above the market or below it? Smiling, aren't you? Look at it. You have it above, you have it above, and you have it above. Plus, we've already had a nice drop down. We've taken liquidity, relative equal lows, inside of a buy side imbalance, sell side inefficiency, right there. Here, let me show you. Background, border, I'll extend it to the right. Okay, boom, trades down to upper quadrant of that fair value gap, which is a buy side imbalance, sell side inefficiency. Okay, let's just put some juice on this a little bit. Think that's random? you think that's just random? It's buying pressure there, guys. Don't you understand? It's buying pressure that turns these markets right on a dime. Somebody collectively tells everybody in a Reddit thread that we're all going to buy at that price. So anyway, the price comes off of that, comes back down. I like the fact that we didn't come down and touch this, because that sets the tone for it's trading up to these levels. Okay, it's going up into these levels for the sake of offering the equivalent to fair value, because all of these levels here are potential areas for engagement for deeper pockets. Okay, and that means that they could, I'm not saying yet, but it could be going up here to create just a little bit of excitement to lull or lure in buyers, and then they take them against the calls and come back down and work in today's new day opening gap again later in the afternoon, or maybe during the 9:30 opening. While I won't be with you and I will be with my wife, I will be admittedly peeking at my phone watching at 9:30 to see what we're gravitating to. Okay, new week opening gap. It's going to take a real move to get up there, and that would indicate something entirely different that would probably put me on the sidelines until we get to like 10 o'clock. Like if, in other words, if we run up there, if we start to really expand up in there prior to 9:30 opening, I would absolutely wait until 10 o'clock silver bullet, and that would be my setup. And I would worry about taking a trade only around that premise, not something, before. Like usually I'll have an expectation in the marketplace where I think it's going to gravitate to this or that level. And if it's above, that means I'm going to be looking for some scenario where I want to see a shift in market structure that's bullish. Time of day, I want to trade inside of a macro. That's the last 10 minutes of the new hour about to begin, or 10 minutes after the top of the new hour. So I'm hunting that type of setup. And those conditions are not there yet for me. But I wanted to sit with you today and have it on the chart and kind of like prove to you, like, this is when you're talking about support and resistance, okay, and you're looking at books like Technical Analysis in the Financial Markets by John Murphy or any other classical retail textbook. Those are absolutely helpful and useful because it gives you what the other traders out there are going to be trying to do, and they're going to try to risk money on those ideas, these archaic ideas that have actually no bearing on what price is going to do. The concept of support and resistance is, in my opinion, too myopic, and I've lost a lot of money trying to trade them because the idea is it goes to an old high, bounces down, and then if it goes up there one more time, the idea that going back up here and touch it again, to me, as a trader with the perspective I have now, is why does it need to go back up there if it's going to be resistance and it started to drop the first time it touched it? Then there's really no weakness there. It's going back there for a reason, right? It's going back there to go above it because people are short and they put their stop losses above that. And it took years for me to figure that out because I wasn't someone that would want to sell short because I was afraid to sell short. I was only trying to buy if I was trying to trade. So when you look at how the market trades around these inefficiencies, these actual gaps, and then because they trade to them and fill them in, everybody else in this industry, before I started teaching like this publicly, they would never worry about those levels again. It was completely tossed out. This got rid of it. It was no longer a factor for them when they would look at price action. And I'm trying to tell you that you don't want to do that. You don't want to do that. They have a life cycle of a high degree of sensitivity that, in my opinion, to serve you as a student, new day opening gaps, you want to have at least the last 5 days, okay? And the last 5 weeks if it's the new week opening gap. And if you have these levels on a layout, you'll be able to see, okay, at the time at 8:30 when we were first talking, I mentioned how we're in between two significant inefficiencies. So nobody can sit there and say, well, it's a so-and-so entry pattern because of this or that, because it's in like a no man's land. But as I was teaching you yesterday, how can you determine what side it's going to push through? And why would it do that? Well, if you're sitting and watching the market, 8 o'clock is when you're looking for relative equal highs and relative equal lows, and into 8:30. And then at 8:30, what are we doing? We're looking for where is the stacking and clustering of these inefficiencies, the new day opening gaps and the new week opening gap. If it's above market price, which is right here at 8:30, where's it most likely going to press into? The side that has all the inefficiencies, even if they've already been traded to. See, this is what I'm referring to. Like, it's already crossed over this gap here. It's already touched the low of it here and dropped. This one here, we went back and forth inside of it and left it, came up constant encroachment to the low. Well, that means it's done, right? Just toss it out the window. It's already been used up. It's stale now. That's what you're going to think that, like anybody else would if they saw a gap fill in. Okay, well, that gap's done. Let's go look at something else. You don't want to do that. You absolutely don't want to do that because the algorithm, this price engine that pushes price, it's driven by these reference points. So what the algorithm does is it calls back to these points of reference based on time and price. What prices? The prices I showed you. What locations on what date? The ones I'm showing you here and what I taught you. And what'll happen is you're going to learn to anticipate which direction the market will push to before it happens. So the next stage in your understanding would be if you're expecting price to reach up, why? Because you have a new day opening gap here, a new day opening gap here, and a new week opening gap up here. And we've already dropped down into a very deep discount relative to the price run from down here all the way up to what we did as a high on Wednesday. So we've dropped down. We're in a deep discount here. It rallies up, and then we're waiting for that news driver to come out to wreck retail because they're going to try to play the breakout game. They don't have any idea what side the market's going to reach for. And the way you build confidence and trust in your trades is you have to do these types of exercises. Notice no button was pushed. Notice there's no trade idea. There's no worry about a stop loss. There's no worry about how many contracts to buy or sell. Because you have to do this drill for weeks and months to overcome that fear of I'm going to get it wrong. How can you trust it? The things I'm teaching you, how can you personally trust these things outside of my word saying it's good stuff? You should take my word for it. I'm telling you, don't take my word. I don't want you to take my word for any of it. I want you to test it yourself because you already see it's valid. The logic is there. And if you can't see that, you're denying it or you didn't pay attention or take notes. Because this is the exact thing I outlined yesterday, where you see the new day opening gap, new day opening gaps, plural, and the new week opening gap. It's above where market price was right before that high impact news driver at 8:30. So what does that mean? Well, let's say it like this. If we would have seen price drop down, okay, and there was a much cleaner fair value gap in here, not the inversion fair value gap that's right there. If it would have had another cleaner fair value gap here, and if it would have dropped down initially at 8:30, that would have been a potential for us to say, okay, we would expect it to drop down to that fair value gap and then expand up and reach into these gaps here. And maybe, look real close, there. Why there? Well, if you look at the range from this high, I'll fix that in a second. It's always in the wrong place. Has that ever happened to you? This box always pops up right where I need to be adjusting something. So here we have the high, down to the low, and where is that? 50%. There it is right there. 50% level there. So above this level, we have this gap here, which is what we've already traded to. But this one here, I like that one because it's also inside of a breaker. See that? Now, if we're using this reference point, do you remember what I taught you about the breakers? What did I teach you about the breakers? I'll give you a minute. Let me get a drink real quick. It should be in your notes. If you have a breaker, which is a high, low, higher high, that blows out the buy side liquidity, during the run up, if you have a fair value gap in there, that's the one you want to focus on. And you don't want to focus on just the down close candles that make the last bit of turn before the rally up, because this is technically your bearish breaker here. But if you have a gap like that right there, that one could be a potential inversion fair value gap. So you have to highlight that and extend it over. So we have this PDA right here, the breaker, and the potential inversion fair value gap that could draw price up to that. Meaning that what we see here, this was indicating the likely direction it would trade up to. And you have to appreciate in the beginning and not punish yourself or tell yourself, This isn't doing it. I'm not making any money doing this. This is foolishness. There should be a button being pushed. There should be a stop loss recommended or something like that. You don't get to that level with confidence, being able to take the trade and hold on to a trade and not get scared out of it or put a stop loss in the wrong place until you do these types of things. And you have to do it daily for weeks and months. And then you overcome that fear of, I don't know what it's going to do, but I'm willing to press the button because I see somebody on a live stream or ICT talked about something. He talked about a specific level. That means it's going to go right there right away. No, that's where my interest is. And I want to then look for evidences and signs in price delivery that it's going to probably reach there. But the first step in you determining the direction or bias, Caleb, is when you're looking at when the market's about to move, which is 8:30 news driver. Even if there isn't any news, you still look for these same signatures here. It just means that if there's a high impact or a medium impact news report due at 8:30, then it's going to be a much more significant, more the magnitude of the move and the speed of the move will be that much more prevalent because there is a high or medium impact news driver. If there is none, then we'll just start to see price just start to move up to these levels. Okay, it's not 100%, but out of 100%, you're probably in 80% or higher. That's the right direction initially. So if you're a scalper, if you're looking for something to get in there and just make a run on some movement in handles and or in forex pips, this is what you do. Okay, you look for these types of signatures, these evidences that the market is going to want to do this type of thing, and it gravitates to it. It's like a magnet pulling price there. Okay, so I just want to real quick add these things on the chart just as lipstick. I'll do this. And we'll do this. Whenever you see a fair value gap that's highlighted in this shade of orange, that's my way of reminding myself as I'm talking to my son, or you if I'm in a video, or if I share a trade. You should already know that I'm viewing that as an inversion. So if the market creates it as a buy side and balance sell side efficiency and it rallies up, for someone that just watches a 5-minute trainer video from somebody else that watches my stuff and thinks they understand it, or watches me do something with a concept of introduced, they'll think, okay, well, this is when it drops back down here, that's a buy. No, it's not. No, it's not. All we did was go up into the new week opening gap, traded at a high, wicked through it a few times, doing the damage, and then we displaced lower. That's not a buy. Okay, so with that, we can now go into where's my lower charts? There we are. Let me maximize this one. So here's a 15-second chart. And there's some of you don't have the ability to see this real time. But here's 8:30. Right there, bang, it opens and quickly runs. In 15 seconds, the market travels from 17,986 and 3/4 to 18,089. Huge, huge amount of displacement. And if you don't know what you're doing and you're gambling, that type of run, especially if you're trying to do these funded account company challenges and they're offering you a maximum of 5 contracts on their lowest thing, and your risk is maximum of 3,000. Don't hold me to these numbers. I'm just trying to remember what Cameron and Caleb were having to deal with when they were trying to do these things. But I think it's $3,000. If it's not, it's something close to that. But they offered, like, you can trade with 5 contracts, or on the larger ones, you can trade with 15 contracts, and that's guaranteeing you're going to blow out. And then you have to pay a reset fee, and they don't have to pay you out anything because you failed. So you just keep paying the transaction fees, and that's how they make their money. Well, on the 15-second chart, we can see it runs into Wednesday's new day opening gap, Tuesday's new day opening gap, and then we have this fair value gap that is above equilibrium on the price run that's dropped since Wednesday's high. In here, we have price rally up, come back down. Look at the overlapping of this candle's high. In the next candle we open, we trade down. Where does it trade to? Consequent encroachment on Wednesday's new day opening gap. You see that? That's this level right here. It touches it right there. And then rallies, leaving what? A fair value gap. What kind? This is a buy side imbalance, sell side inefficiency. So if it's likely to keep going higher, because it's going to dig into this one and maybe reach into this level, we don't need to know it right away, but because we have this potential new day opening gap we can draw up into, there's range between trading on this fair value gap being repriced to, and how far can it overshoot this gap? We'll look at the overlapping of here, where this body and this body agree. The top of that one and the low of that one. That right there is a PD array. One of the 81 that supposedly I don't have. It can touch that perfectly. What's the open on that? 18,081 and a half. What's the low on that candle? 18,081 and a half. Perfect. Perfect. And then it rallies. What does it create? A small little volume imbalance inside of, and real close to what? What's between these two levels here? Buy side imbalance, sell side inefficiency. So we want to see it form support or an inability to trade to the midpoint of it, or if it does, it needs to repel it immediately. That looks like this. See, every time I do that, it jumps. There. So here's consequent encroachment of that buy side imbalance, sell side inefficiency. We trade down to some random quadrant level. See that? And then what does it do? It rallies. This is good. This is good because it leaves this volume imbalance open and it doesn't come back down to the midpoint and starts to rally. Then the market creates every little down close candle needs to support price because that means it's acting as a bullish order block until we get above here, and it does, and trades to the high of that new day opening gap on Tuesday, which you derived that information from Monday at 6 p.m. and the difference between Monday at 5 p.m. to closing price. The market trades back down into down close candles here, just outside of the Tuesday's new day opening gap low, hammering around back and forth inside here. If this falters and fails and goes below this candle's low, to me, stand aside until 9:30 opening. Don't try to Mickey Mouse and play games with it because it'll probably hurt you. Trying to figure out what this level is here. I'm not sure what that is now. Oh, it's the midpoint of the overall range. I was like, oh, what is that line? It's the measurement of that high on Wednesday to the low of yesterday. So let me get that up because it's distracting. But while you have these levels in mind, and when they're in close proximity, you want to have these on your chart for trade purposes. You don't have to have every single one of them on your chart that you're going to operate on. So again, as I was mentioning yesterday, you want to see them on a layout that you can refer back to that's outside of your operating trading layout. So over here, like where I have live trading, this could be labeled as new day opening gap template. Okay, or it could be new week opening gaps and new day opening gaps. If you want to have a lot of stuff on your chart and you're comfortable with navigating all that, you can put them both on there. I personally don't recommend doing that, but I'm affording you your own personality to be implemented here. So I'm not trying to say this is the best way to do it. It's up to you how you want to annotate your charts. I'm just saying that this is how I'm coaching my son to do it. So that way his charts will look easy to me in understanding what he's annotating, because it's something I've instructed him to do this way. So that way we're not trying to make it harder for me, because I'm a little older in cantankerous now, being 52. So here we have a potential immediate rebalance. Oh, yeah, my bones are telling me I'm 52 today. All right, so the initial run from 8:30, unless you were already positioned long from early on and you're just using it for a momentum run, like trying to get to a higher time frame objective above the marketplace, your ability to get in the move, when it moved like 100 handles in just like 15 seconds, you're not going to be able to pull that off. Okay. Using the ideas I just outlined when we were in the 15-second chart, that's the closest thing that could have been implemented for me, and I'm ICT, so that's the best I could have pulled off using the information that, as I taught yesterday, that draw would be deciphered and determined based on where the market was at right before the news driver hits. And then that means I have more probability that the market's going to expand higher. Why? Because I taught you yesterday. Go back and listen to it again. If you didn't listen to it, go in and listen to how I explained. If you start looking at a chart or a layout that has these new day opening gaps, and you start seeing clustering above it, above wherever you're at, waiting for a setup to form, when? Between 7 o'clock, 8 o'clock, and 9 o'clock. Well, we have a sweet little cherry on top with the fact that we have a news driver today at 8:30. So that means the attention and focus is going to be where? Is it going to be in the first 30 minutes of 7 o'clock Eastern time? No. Is it going to be ahead of 8 o'clock? No. It's going to be right at 8:30. Why? Because the economic calendar is your TV guide to the next important event to watch on TV. Okay, so we're watching price like television. Our interest is peaked when? At 8:30, because the news driver is going to happen. And that volatility that will be introduced, why? Because the market is going to spool. It's going to run real quick. Look at your time and sales data at 8:30. Look at it at 8:29, at 8:28, 8:27, 8:25. How much buying was taking place there? How much buying took place in the run up in this just one single candle at 8:30? You're not going to see an exorbitant number of contracts. It's the fact that it's being repriced there aggressively. So how's that happening? The price engines, that's an algorithmic artifact. It's something that is driven by automation. It matters not how many buying of the asset or contracts, or if it's a stock, it doesn't matter how many shares are being bought. It's going to be pushed up there. And then when it's at these lofty price levels, then it's your task to see, does it justify being there? And if there's reasons to see it sustain a run higher, then you don't look at anything that would otherwise look like a reversal pattern. You cancel that out and you look for continuation, which is very, very hard to do when you're brand new. So I'm looking at that volume imbalance right here, and the fact that we came down and touched the top of the Tuesday new day opening gap high. So we have two little PD arrays inside of this order block there. So I want to see, does it want to make a run for the high here and start squeezing towards that fair value gap up there? It's already done enough for me today. See, some of you need to see me push the button as it goes down into that volume imbalance, and use a stop loss that would be right at the rejection block right there on that close. That's where your stop loss would be. So what's the risk between that and getting in at the high or the open of that candle, which is the volume imbalance, inside of that order block right there? Devil's advocate, you can be worst case scenario and use the opening price of that order block and say that's your fill, and your risk is the close of that candle. You're watching this level here. It could have wicked below it by a tick, but that's about as much as I would have expected. Why? Why would I have only expected that much? Because it's already filled in this volume imbalance there. Two bodies. This body's inside that volume imbalance too. Then we had a wick in here that went below that. There's no need for it to go back down below that except for one tick. We have the low of this candle and the high of that candle and the single pass through at sell side delivery. Inefficiency is on the buy side. That means until this candlestick here, that high, the difference between that and this candle's high, that is your inefficiency still. Okay, so it looks like that. And what does it do? It trades up just above that on this candle there. But why did I pick this fair value gap? Why did I do that? Well, if you go back and look at where we were here before 8:30 started to run up, I measured in front of you this high, dragging the Fibonacci down to here. The only use of a Fibonacci for me is I want to know where the midpoint is. That's all Fibonacci does for me, because that determines if it's overbought or oversold. I don't need an indicator to tell me that. You don't need an indicator to tell you that. And divergence on any indicator is useless. It doesn't mean shit because you're compressing numbers. And if you beat and torture numbers enough, the data will submit to anything you want it to say. So it's a matter of looking for where are we at in the range. So can you see clearly that this is the range high all the way down to that low? So the most recent large degree of directional movement, right at 8:30 as it happened, where was the profitable trades being held? The longs or the shorts? Predominantly it's the shorts. Why? Because it's been the most recent protracted directional move and it's been going lower. So when we have these big ranges like that, it's important to measure with the fib. That way, if you're going to go long, or if you're anticipating it's going to go long, why would we anticipate that? Because what I gave you yesterday as guidance, I'm gonna slap you around a little bit, getting you stay stuff like this. I got to get it out of my system. But 50% is here, so that's equilibrium. So at that level or below is discount. At that level or above is premium. So we're here at 8:30. I taught you yesterday that if there's clustering with the new day opening gaps and a new week opening gap, if that's above where the market price is and you're anticipating price to have a movement, one directional, okay, or high impact or medium impact news drivers are likely to create a spooling in price where they start gapping price higher. And you see that in that 15-second chart where it traversed over 100 handles in 15 seconds. And you think that's buying pressure. It's not. How many contracts were traded at 8:30 to make that 100 handle run? When I get done showing this again, I'm going to drop down into like a 1-second chart, and we'll look at that first 8:30 to 8:31 movement with a 1-second chart. It's illuminating. So because we have equilibrium here, and I'm anticipating based on the logic I taught you yesterday, if the market's here before the news driver is going to be the retail's excuse for why price went up when it's not. It's just the highlighting of the time when the market's going to start spooling. Spooling is just like when you have a fishing rod, okay? And you put your little anchor, your little sinker on the end of it with your bait and your hook, and then you cast the fishing rod out into the water. The fishing line, when it starts leaving that spool, that reel of fishing line, as it's going off that reel, it's shooting off, but it's being unraveled real quick, and it's shooting out the length of the fishing pole and out into the water. That's exactly what's going on when the algorithm starts running. When it enters into a buy program, boom, it starts spooling higher. When it enters a sell program, boom, it starts going lower. Your task is to understand the characteristics when the time is likely to see that unfold. When there is no market driver, when there's no news, like at 8:30 or the 10 o'clock reports that come out, or sometimes there's a 9:45 number, or 10:30 if it's crude oil inventory. When you have all those reports or those times of the day, they're pretty generic. Everybody knows that. But there also are things like I taught as a macro. It's the first 10 minutes before the top of the hour and 10 minutes after the top of the hour. The market will spool there as well. They'll start running. What is it running for? It's running for liquidity or rushing to get into an inefficiency. You probably hear Bailey in the background barking. I apologize. I think it just got a good food. And thank you for the birthday cards, by the way. There's too many of them to show. I showed one of them, Moses. Thank you again. But I just don't. I know some of you probably would like to see your stuff show up on my community post. I don't want to do that. But that day I just got one, so that was nice. The fair value gap that I chose here is above the equilibrium price point. Okay, and it's also inside of that breaker. And if it's going to trade above this, where could it trade to as an upside target? This area here that could act as what? The inversion fair value gap. So it's those levels we look for. Okay, so how can we use this information in a trade idea? Let's go back down and get this Fibonacci off. Let's go into a 1 minute chart. All right, and then when price had this big run here, that's not what I want to do. Let's go into a 15-second chart. I apologize. Look at the reaction off the low of that fair value gap there. It's probably random. Don't pay attention to that. It's all selling pressure. The balancing between this candle's body and then open and trading down here, that makes this from this low to that high. That's a balanced price range. What? Yeah, that's balance. That's balanced price delivery. Both directions have been offered. It's from this low that we don't know yet is formed yet, but it's also the same low that makes the consequent encroachment of Wednesday's new day opening gap. See that? So all these things are converging. This run away from that and then close. We open, trade down to that consequent encroachment, and then pass through and leave that high there. That means that this high is a balanced price range down to that low. Because between this candle's low and that candle's high, price has been offered up and down. That's balanced. That's balanced. And the market trades back down, and you see them hitting the closing price here, and digging into this candle's open. Hits it perfectly, rallies. On a 15-second chart, you can use order blocks as your entry, small fair value gaps, volume imbalances. I love them if the direction's still in play. Okay, and we were outlining this level here. So anytime you see a convergence of a new day opening gaps, low, high, or consequent encroachment level, and a down close candle and you're bullish, it leaves it and comes back down in, you can use that as your catalyst to study price. Does it behave and run to your objective? I gave you the objective today. I outlined how the market will behave yesterday. So I pointed out the volume imbalance. I pointed out the fact that we came down and touched the top of the Tuesday's new day opening gap. And then we want to see, does it rally up and go into this fair value gap? And we got that. Okay, 70 plus handles, if not, whatever that is, on a very small run, but after the major damage was done. So I used the logic in front of you. We didn't touch market replay. To do that, you got to do this. Okay, you see how that changes the bottom of my screen down here? My screen never looks like that. It never looks like that because ICT knows what the fuck's going on. I don't need to use no market replay to guess, oh, let's start watching and going forward. The hell with that. It's dumb. Okay, dumb. I want to leave this. Yes, I do. So that's why my chart looks like that. Okay, even if I maximize it, I don't think you can pull up market replay when you do that, can you? No, you can't. So there you go. That's why I showed my screen maximized. I go through all this to prove to you that all this stuff is happening in real time. The market's open, countdown to close of the candlestick. I mean, it's all there. But there are specific things that you're going to find that they're real signals that you want to participate in. There are setups that are more likely to pan out than just looking at, oh, well, it's trading down into a down closed candle, so it must go up. No, there has to be other contributing factors to it. And when you're looking at things that are outside the candles, a la new day opening gap, new week opening gaps, the separation between those price levels, which is event horizon, those types of things, they're like dark pools. They're things that the general public are not privy to. They're not something they can reach for and say, oh yeah, this is. They're looking at indicators. They're trying to overlay stuff on their chart and looking at mathematically crunched data, thinking that that's what's going to cause the market to go up and down. No, the only thing that's doing is providing liquidity for people that use that logic, and they put orders in the marketplace based on that bullshit. And then we go in like a cannibal and devour them, and they don't even know what just happened. And we're going to go back the next day, do the same thing all over again. And as long as they have money in their account and buttons to push to do so, and we'll be cleaning their clock again. And that's the life cycle. Stupid money, street money, dumb money being cannibalized by smart money. And smart money uses these concepts. Look at what the market's doing. Consequent encroachment. I told you this level before it happened. It traded up to it and then hits it here. So what is it indicating? It's having resistance, right? It's having a hard time. And then it breaks down. This level, or that low, after it touches this, trades down below that low. What does that mean right there? It's a shift in market structure. So what is it going to do? It's probably going to trade up to a short-term premium. What's it going to trade to? See that gap? See it? There to there. What's the bodies over here respecting? That. But the wicks are allowed to do what? The damage. How far can it go? Well, do you see the volume imbalance right there? These are all things that you annotate and screenshot as prices doing what you're watching. And what does it trade down to? Some random bullshit NDOG, some horseshit. It's all made up. It's all make believe. I renamed this from something apparently. Find a book. Find the VHS tapes and courses that talks about these new day opening gaps being used like I taught. It ain't there, folks. But guess what? It's all over on Amazon right now. It's on Amazon right now. And it has my logo somewhere in the book, or my name on the cover of the book, ICT's Inner Circle Trader Secrets, blah, blah, blah. And they're teaching it through ignorance. They have no idea what they're talking about. The only thing they're doing is parroting what I said. And that's why people that leave me notes and stuff, you talk too much, because that means they got to listen to all that shit or try to condense it. And they failed in school. So they're trying to do, with John Fibellati did, make a book with a bunch of bullshit, and it's all my stuff, but supposedly credit everyone else that has nothing to do with them. It's because he wanted to do a cash grab. Until I put a review on there. Come to the YouTube channel and you'll see this guy's a liar. That's what you get from the multi-level marketing gurus, 20-year-old rip-off artists. Hits it, fails, volume and balance, fair value gap. The takeaway is this. When you have a fair value gap and you have small little cracks in the delivery price like that little tiny volume imbalance right there, this tells you where the wick can go, but how can you trust the trade is still viable? Or if you miss this first run up here, can you trade it if it goes into it again in here? Yes. That's a reclaimed fair value gap. That's the fact that the market's offering that again. It's reclaiming that fair value gap. But the wicks are doing the damage. So how can it run against you? How far can it run against you, rather? Well, it can trade into that volume imbalance. But if it does both and it starts to slam down, you really are being like a billboard sign, like on an interstate, saying you're running low on gas, or if you're hungry, pull out on this exit here because we have the goods. It's a good thing to come this direction. Well, that's kind of like a neon sign saying that the bodies are staying inside this fair value gap. These are all things that you're going to annotate while you're watching price. What the hell's going on there? There you go. okay? And look where the body stopped. I mean, really think about this, okay? Think about the bullshit that people are going to tell you, and you've read in books, and you probably believe right now, if you're new, that markets are random, it's all buying and selling pressure. What the fuck are the chances of this candle's low and this candle's high that is my fair value gap? Midpoint is consequent encroachment. That means it's encroaching into this space again. It's consequential. It's likely to happen because therefore, if it's going to return back to it, this is what you expect. That's why it's consequential encroachment. Look where the bodies are. You see that? What's the wick doing? The damage. To what? To what degree is that wick going up against the underlying expectation? If you're going to trade with this pattern, what is the extreme of how far that wick can go? Well, look back over here. We have this short-term high. Does it go above that? Sure it does. But how high can it go above that, ICT? Look to the left. What do you have left? Volume imbalance. Deliver, one tick above, back down in. Consequent encroachment. Consequent encroachment. Fails to get to the consequent encroachment. That's what you're looking for. You want to see the next candle start to dive, go lower. Does it? Oh, wow. Now you can use this as an institutional order flow entry drill. Trades up into that gap, but you want to see that left open. You don't want to see that fill in, because if it can leave that open, guess what that means? It's a breakaway gap, and it's probably going to remain heavy, and it may afford you 15, 20, or more handles, something to that effect. And you're weighing out all of these potential delivery mechanisms. Your stop loss would be here. Here's your fair value gap, institutional order flow entry drill there. It spikes up, yes, but beforehand it trades down to the low of the new day opening gap on Tuesday. You would take a partial here. If you were holding on for more, chances are you probably would have got stopped out, because you would have definitely been moving your stop loss below the fair value gap. But you're paid. You're paid. And if you did something like that, if you had an expectation, maybe you're watching on the chart right now while I was talking, and you were looking at something like that, that's a plus. That's a win in your learning. Not that you should have been taking a trade, by the way, but if you were watching and observing it, relative equal lows. Top of the Tuesday. Let's see if it can spike down below that. You can make these drills as small and as minute as possible, and then looking and judging how does it behave. Or you can look at it from, I want to see it try to traverse over a span of 20 to 30 handles and study each one of them. And if you're looking at a 15-second chart, it gives you a lot of examples where you can do this and just study what is it doing, how's it behaving, what levels is it respecting, how fast is it going away from a level, how fast is it drawing to a level, and or is it starting to stagnate, is it having a hard time moving around. All these things are things that you need to be conditioning yourself to observe real time, because that's the experience that you're going to lean on when you're trading with real money, or when you're trading a funded account challenge, or when you're trading with a funded account with a prop firm, or if you're managing other people's money, because I have students that are delving into that now. And I'm not talking about Mickey Mouse money, like millions of money, which my opinion, and you know who you are, just recently emailed me, my opinion is no comment. If you're choosing to do that, I have no input on that. I just know that it's very, 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 very stressful. If you're okay with that kind of stress, have fun. Don't do anything differently. You already know how to trade. Just trade with a whole lot less risk. But I don't want to comment anymore on that, because I'm not going to do that, because I just know it's very, very stressful to manage other people's money with that level. But I think that's it. I gave you much more than I wanted to. You got another 46 minutes beyond what I said I was willing to do today. I spent a little bit of my birthday with you. See that volume imbalance? We wicked above that new day opening gap to what random level right there. And then we move back down to make another lower low. Watch right here, okay? because all of this is pretty well balanced. If it remains heavy at 10 o'clock or leading into 10 o'clock, we might get some kind of a silver bullet. It could try to explore a little bit deeper in here. It doesn't mean it's going to keep falling out of bed, but based on what it's doing right now at the very moment where we're looking at it, I'd give it an opportunity to see that. I would rather see this stay open, or not open, but not traded too, because they're relative equal highs right now. I'd like to see it come back down and upset this. Where is it at? Right here. Come down and hit that. And let everybody think it's going to drop, and then rake them across the coals and take it back up here in the afternoon or going into the lunch hour. If I was making the market for NASDAQ, that's how I'd do it. But I'm just a demo baller. I don't know anything. So this is a 1 second chart. That means every single candlestick in this time frame is represented by 1 second of open, high, low, and close. So right here, that's 8:30. Right there at the turn of 8:30 even. Notice there's no additional seconds or anything like that. And then we had this big run. So in 1 second, we traversed from 17,986 and 3/4 to 18,037 and 3/4. So in 1 second, boom, just like that, 50 handles or so. 1 second. If you're offside and you're trading one contract, man, you're getting pinched, aren't you? What happens if you're doing that 15 contract, trying to use a funded account? You're smoked. Well, let me get the refund this account link here and put that through. Got to lie and tell my wife I had to buy a tire. Market drops down, rallies again. What is this? What's that right there? It's a fair value gap, but where is it? What's this level right here? Consequent encroachment on Wednesday's new day opening gap. So you have a fair value gap. It drops down 1, 2, 3 times. Rally. Trading up into Tuesday's new day opening gap. Trades back down into all of this, which is a balanced price range. What makes this a balanced price range? If you look inside, there you have, come on. Up, down, up, down. So it's painted, like say this is a wall in your house. The paint is coming off that roller really ample, really nice. And then you start going to another area where there's no paint yet. And you paint all this up here, and then you come right back down to where you finished before. You don't need to go deep into that. Why? Because this has all been balanced. And that's why you see it's right down to here. There's no need for it to explore into this range deeper. So what is it doing? Using quadrants of that same balanced price range. Put your fib over something like that and study that. See what it's doing? Everything is mathematically controlled by an algorithm. Everything. But it has to refer to specific things in price action that's already happened. All of these calculations are happening so fast because it's computerized. And it's cycling through time frames, like real quick. And it's referring back to them really quick and making decisions and bang. But you think this is buying and selling pressure because it's easier to disbelieve that. It's easier to believe that, and it makes you sleep at night that it can't be this manipulated and controlled. Because if it's this manipulated and controlled, that means that they have strings on it and they can tug those strings anytime they want and have an outcome that they want to see. And that's all I'm trying to tell you. That's what it is. And you shouldn't be mad about that. You should be thankful that the markets are rigged. I am. I'm certainly thankful of it. I don't look at it like a casino and say, you assholes. I know if I go there, I'm going to lose my money because it's rigged to the degree that you're going to screw you. And if you start winning, they're going to escort you out the door. You're not going to be allowed to play there anymore. Ask any card counter in Las Vegas. They know them, and they're not allowed to be in there because they're beating them. Does that sound like it's a fair place to gamble at? No. If somebody can count cards, guess what? That's not easy to do. It's not easy to do that. So they have a skill set, and they're matching that skill set against your probabilities and your stacked decks, and the eye in the sky, and the rigged games that they use. But even on a smaller time frame, like a 1 second chart, you can see the same phenomena is repeating. Fair value gaps, trading to the levels, reacting off of them. Look how it's gravitating around the lower quadrant and the midpoint consequent encroachment. Look how it respected it here. A 1 second chart. Look how it respected there with the bodies. All this in here on a 1 second chart. And there's no algorithm. There's no way there's an algorithm. There's no way. You could never prove to me ICT there's an algorithm. Where's this algorithm at? I heard Tom Hugard, somebody sent me a clip. Tom Hugard said, where is this algorithm? It's in your charts. That's the closest thing you're ever going to see. But if you don't want to believe it, because it upsets your narrative or your school of thought, it's just much more painless for you to say, no, I don't believe in an algorithm. Okay. You're not going to make me have the same thought process. That's for fucking sure. That's not going to happen with me. But look at this. This is Tuesday's new day opening gap, and you're looking for support and resistance and failing at it because the support and resistance lines you're putting on is what the books tell you to do, an old high and old low, and we target those things. You see how that's a completely diametrically opposed paradigm shift from what the losing crowd's doing over and over and over again, and the way they see price, and they're not smart enough to stop doing those things and reverse it. Just do the opposite of that. And then treat these levels as an opportunity to be attacked because there's orders above them. How hard is that to understand? For the life of me, I don't understand why anybody with any common sense can't see the truth in that. Versus, I'm looking for a pattern, a harmonic crossover, this, that, other thing, ratio trades, and all this horse shit. That's complicated to me. That's a complication. I went through all that dumb shit. And then I said, okay, what is the real mechanism here? Because when I put a trade on, if I get stopped out, I've lost. So if I lost, somebody got that money. What were they doing to get to my money? Trading the other direction. Targeting my stop loss. Well, if that's the case, then it should start happening all day long. And there it was. Where do these things form? Time-wise. They're like traps and snares. They lay them down in the same spot all the time. You go out in the woods, if you ever go anywhere in the woods, you'll see a hide. It's called a hide where hunters will have usually like a tree stand or something to that effect. And it's sitting there. And they might put deer feeders or whatnot all around them. And they just keep feeding because they want the deer to keep coming around. And then when they want to show up to hunt, they go and they come up in their hide and they wait for the deer to do what it's been trained to do. Keep coming here as food. Well, that's what the economic calendar has done. It's a watering hole for the lions to wait for all the gazelles and the dumbasses to go down there and get a drink. And when they go down and get a drink, it's their last supper. And lions eat. That's what the economic calendar is for me. It tells me the time when the gazelles are going to the watering hole. It tells me when my next meal in the marketplace is coming to get devoured. And I can choose not to go down to the watering hole if I have something better to do. And that's a whole lesson in itself. Just because that there's time and opportunity for you to be in front of the chart doesn't mean that you should be. And that's maturity. That's you navigating your emotions. Look at this, man. Look how it's respecting these levels. Some random bullshit line dropped on a chart that the goobers will tell you, oh, eventually it's going to touch one of those lines. Missing the entire plot, like missing the whole point of what this is doing for you. It's giving you a means of determining where price should fluctuate from or gravitate to. This is the real support and resistance that you think that these books are teaching you. And when you try to do it, it's never the right resistance because it goes through and just keeps trading higher. Or it's never the right support. You try to buy it and it just right through it. It's demoralizing, isn't it? Consequent encouragement of the fair value gap, I told you. Hit the low of it. Boom. Look at these levels, man. This is 1 second. It looks just like any other time frame, doesn't it? Trading down to the low of Tuesday's new day open gap. Look at that. There's no algorithm. There's no fucking algorithm, man. There's no way that these markets are rigged. You could never convince me of it. I'm telling you, every time I read somebody in somebody else's YouTube channel comment on that and say shit like that, tell me you're an idiot without saying it. That's exactly what you just did. Because all you have to do is study it and see it. It's there. How the fuck is the buying and selling pressure of all the traders in the world stopping these prices on a dime and respecting these levels that no one's ever talked about until I started talking about it? But you can go back in time before I taught them and you can find them in your chart. But you can't find Tom, Dick, or fucking Harry or mentors ever telling you about it. That's not me beating my chest and bragging. I'm just trying to show you that this stuff is valid. But the people that can't do it, or made a very big argument about it online, that there's no algorithm, now they're forced into a huge mob of all of you now that you know it. And some of you are very vocal. And I'm telling you, leave them in your ignorance. Just leave them in it. It's better for you to do that. Just let them stay stupid. They're just like that gazelle. The only thing they can think of is, I got to get a drink, and there's the watering hole. Let me go down there. And they're gone. Ghosted. And where are we at here? What's that other level I told you it could gravitate to? Do you remember? That inversion fair value gap above the breaker. There's that gap I told you about. High, low, higher, high. This is where I can draw to if it goes above here. What's your chart show? Does your chart show this? What about that? Into that balanced price range that I showed you a little bit ago. So what I have in front of me when I'm trading, the only thing I worked with today was the laptop that you have. I'm holding. I swear in the Lord's name that all of my monitors that I have in front of me are all off. They're all off. But what I have on my charts is I have a 15-second chart, a 1-minute chart, a 5-minute, 15, an hour, a daily, a weekly, a monthly. And then I have a chart that I call a matrix, where it's a 5-minute, 4-minute, 3-minute, 2-minute, 1-minute chart for the NASDAQ, the S&P, and the Dow. And what I'm doing is I'm looking for S&T divergences on all of them at the same time. When I'm anticipating a fair value gap to form or a run above old highs, I want to see it diverge. One of them will fail. And that's like it's not a necessity for my trade, but it's just one of those things I like to see as a qualifier. It gives a little bit more quality behind my analysis where I already think it's going to do something anyway. And then it just behaves that way even more quicker and more strongly in my favor. And the speed usually really starts to deliver because I have that signature behind it. So you don't need SMT. Like, you really don't need it to be in your trades. But I like to look for it because it gives me that little bit of, okay, she's going to run now. And then she starts taking off, whether higher or lower based on my analysis in the SMT divergence it forms. So I want you to go back and listen to this again, okay? And you'll hear me talk about how, if I was making the market, I would drop it down, take it down into that area, wipe that out, and then run above the relative equal highs. Earlier in the day, I told you that it's going to run up into here and run up into here if it goes above there. It's delivered all that, folks. I'm a fucking fraud, right? I'm a fraud. I'm out here doing this in front of you with a live data feed on the smallest of fucking time frames. 1 second. Can you get any smaller than 1 second? TradingView, I know you're listening now. Can you give me a time frame less than 1 second? Because if you can, I will trade that too. Okay, I don't have any access to that. Okay, it's this is what it is. So I don't know what else to tell you, folks. Either you're going to sit down and listen, take notes, and then just try it. That's all I'm asking you to do is try it. I don't have to give you a refund because you didn't pay for this. You're putting your time in to listen to the rules, what it looks like, how to practice it, and observe and capture the information, logging it. But all of this information doesn't have to be on the same chart. But you should, if you can, afford yourself a monitor, at least one extra monitor, where you can have this information on a blank chart without the other stuff there. But because I'm trying to teach you from the ground up, a lot of you only have one device. That means you're stuck with one chart, one screen. So it's a little bit harder. It's a lot more juggling between time frames and whatnot, and you'll have a little bit more stuff on your chart. But it's possible to grow from that. But you should have a chart that doesn't have like the fair value gap I have here, or that there, or these, or that. Okay? And I taught you yesterday that, I'm sorry, in this too, this shouldn't be there either. So you just have your new day opening gaps and new week opening gaps. I told you how many to have and why. I told you how to determine the bias yesterday, and I told you how to use these new day opening gaps and new week opening gaps in relationship to when you anticipate price spooling and moving directionally, and how to determine what direction it moves for. Well, we were here. Where is the clustering of all the new day opening gaps? Is it above or below that? Above. Here, here, and here. So where's price going to go? Up. Then I told you, look at that fair value gap right there. And then if it's going to go above that, it'll reach into here. It's done that. I would be done. If I was trading, I'm done. I'm not doing shit now. I'm not worrying about the afternoon. I'm going to have a strawberry shortcake for birthday cake today. I'm going to chill. I'm probably going to watch a movie with my wife in my theater. I'm going to kick back and relax and enjoy being 52.